Hello, I'm Shaun Richards of Notayesmaneconomics, and this week I want to talk to you about asset prices and house prices in particular. Why is this a big deal? Well, this is because through the last decade or so, central banks have particularly keyed into this. Pretty much every move we've seen them make have been to get these higher. The theory from their point of view is that if they get asset prices higher, people feel richer and they'll spend more. There's some weaknesses in that line of argument, but that's what they believe, at least publicly. The reason why this is in the sort of news to some extent, or on my mind, comes partly from China, actually. If we look at the situation there, if we just look at it simply in terms of the stock market, that entered a bear market yesterday, depending which index you use. Others fell today, so there's been a sort of addition to it. This is on my mind also because there's various influences there where we're seeing developers' prices fall, which makes me think of house prices. The situation there is quite extraordinary. The prices in many cities seem to have, in relative terms, blasted way beyond London. What I mean by that is that on one measure I was reading, that compared to sort of United States cities and comparing relative incomes, things are 700% higher, which as you can see is quite a lot. Taking that further, and the situation of rents, because like in so many places, if people can't buy, they get pushed into the rented sector, there's issues there too. And here's something that may intrigue you. In China, there are mortgages for renting. So you borrow the money, say for 5 years, and put that down up front. One intriguing bit I spotted was that you could borrow the money for 10 years for your 5-year mortgage payment, which has an obvious problem. But in the modern era, no one really worries about that, do they? It moves it 5 years down the road. Moving on though from a bubble that's raging, which is like China, and questions as to when it might end, today in the UK, we're seeing a sort of much more mature phase of this. What do I mean? Well, in one way, we're proving that a bubble doesn't immediately, at least, have to go to a collapse. If we look at the nationwide numbers this morning, they say that house price growth has now dropped in annual terms to 2% in the UK. And if we look at that against other numbers, that brings it down much more like with rents growth, wages growth, and to some extent inflation, depending how you measure that. So this is a clear change in the structure in the UK. And so far, as I said, at least, we've shifted from boom to slowdown without there actually being a bust. Doesn't mean there won't be one, just means there hasn't been one so far. This will provide a lot of food for thought for the Bank of England. Why? Because 6 years ago now, and something that fed into the numbers 5 years ago, it embarked on a lot of policy changes to kick the UK house market higher. So from that point of view it worked, but they ended to some extent in February of this year. So this morning you can imagine my eyes lit up when I saw the nationwide numbers saying lowest house price growth for 5 years. And so you can say that the sort of Bank of England thing is washing out of the system in terms of house price growth. Got to be careful here though, because of course house prices are now a lot higher. Hasn't completely gone out in that term, but in terms of annual change it now has. And this will give the Bank of England quite a few things to think about. Is it going to go back to its regular playbook, try and kick them higher again? Or will it go quiet for a while? Some of its more recent moves, have gone in that direction. What have we seen? As I said, one or two of the policies have sort of washed out the system. It reversed the panic-ridden bank rate cut of August 2016, so bank rates back to 0.5%. And we haven't had any more QE for a while, so it has stopped trying to push things higher. And another factor that might come into play here, if we look at it, will be just simply on the term of Governor Carney. He's had 5 years or so now, pump things up. For the next year, will he want to push it on? Because really, any change in that will mostly now come in the term of his replacement. Is he that bothered? We may see that he's now bothered about what he'll consider his legacy, and so might tighten things up a bit. So, looking forward, there is a possibility that house prices across the country could be pushed negative in terms of annual growth terms. So, copying London. Because this morning we were told by the Nationwide that house prices here in London fallen by 1.9%. Probably a bit more than that, literally around here, in the sort of Belgravia offices where I'm now sitting. And so we're seeing quite a big shift around. How is this a thing? Well, This is where international trends come in with the national. Bank of England wanted house prices higher, got that. London really boomed, partly because it gave it a push, partly because of world influences. Capital cities have gone up. Also, people wanted to park their money in London, and particularly in the UK. We might not think of it in that way, but things like our legal system and so on has its flaws, but does mostly work. That's not quite true all around the world. And of course, from various countries, we've seen people want to get their money out. Where's one of the places you might put it? London, London property. So there's been a whole raft of factors washing in and out of the system. Bringing that back to economic effect, where does that leave us? Well, I have two thoughts for you. I started with the central bank line, that these things lead to wealth effects, growth, things are great. However, for those that are looking to buy, be it you're a first-time buyer, or on my mind at the minute, because I've got some friends looking at this, say you want a bigger place, they've had a son, then it gets difficult because you find that you're facing inflation. It's not growth at all. So the money that's claimed that's gone into the system, in my opinion, in these areas, then gets sucked back out. We could even have a net negative. So there's quite a bit to consider here. And if we return to a hobby horse of mine, then this is the main reason why I pursue the issue of how you measure inflation and why I think house prices should be in it. Do people pay house prices every month? Of course they don't. But some people pay their mortgage every month, a reflection of that. And there are people buying houses. So I think it should be in the number rather than rents, as they've put in. Because if you own a house, you don't pay rent. Completely different to those buy-to-letting where someone is renting. But that's not the way the establishment looks at it. And I guess you're not going to be surprised if I now tell you that the way they look at it brings the inflation numbers a lot lower. So in conclusion, a few thoughts for you. The standard playbook in the credit crunch era has been to take house prices higher. We get told that that generates economic growth, but that's recorded economic growth in the way that they do it. In my opinion, by the time we put house prices properly back in the numbers, quite a bit of that fades away, and that explains why people think they're not a lot better off when they're told that they are. Thank you.